A pipe bursts in the middle of the night. Water spreads across the floor, ruins the furniture, soaks into the walls. The homeowner is stressed but relieved because they have paid for insurance every single month for years, specifically for moments like this. They file the claim expecting a fair payout. Instead, they get a letter explaining that most of what they lost is either excluded, undervalued, or simply not covered the way they assumed it would be. This scene plays out every single day, and almost every time, the answer to why was sitting quietly in the fine print the entire time, in a document most people sign without fully reading. Insurance companies are not charities. They are businesses, and like any business, they make more money when they collect more in premiums than they pay out in claims. That single fact explains almost everything about how policies are written. The fine print is not an accident or bad writing. It is often carefully constructed to limit exactly how much the company has to pay, while still technically offering you coverage. Understanding a few of these patterns can save you thousands of dollars, or at the very least, save you from a painful surprise during the worst possible moment. The first pattern to understand is the exclusions section, which is usually the most important part of any policy, and the part almost nobody reads carefully. A standard homeowner's policy, for example, very commonly excludes flood damage entirely, even though most people assume water damage of any kind is automatically covered. Someone only discovers this exclusion after a flood has already destroyed their home, when it is far too late to do anything about it. The lesson here is simple. Before you ever need to file a claim, read the exclusion section first, not last, because that section tells you exactly what you are not protected from, no matter how confident the sales pitch sounds. The second pattern is the difference between actual cash value and replacement cost. Two phrases that sound similar but can mean a difference of thousands of dollars. Actual cash value means the insurance company pays what your damaged item was worth right before it was destroyed, after years of depreciation, not what it costs to buy a new one today. Replacement cost means they pay what it actually costs to replace the item brand new. Imagine a homeowner whose 10-year-old roof is destroyed in a storm. Under an actual cash value policy, the payout might only cover a fraction of a new roof because the old one had already lost most of its value through age and wear. The homeowner is left paying the difference out of pocket, often without ever realizing this distinction existed until the check arrives far smaller than expected. If replacement cost coverage is available as an option or an added endorsement, it is very often worth the extra cost. The third pattern is the waiting period, most common in health and dental insurance. Some policies will not cover certain procedures until you have already held the policy for a set number of months, sometimes as long as a full year. Someone who buys a health plan the week before a planned procedure may discover that exact procedure falls inside a waiting period, meaning they are paying for a policy that will not actually help them when they need it most. This is exactly why reading the Specimen policy, meaning a sample of the actual contract before purchasing anything, is far more useful than simply trusting a summary brochure or a friendly sales call. The fourth pattern is sublimits, which quietly cap how much you can claim for specific categories of items, even inside a policy with a much higher overall limit. A policy might advertise $50,000 in personal property coverage, while burying a separate, much smaller limit specifically for jewelry, electronics, or business equipment kept at home. Someone who assumes their laptop, camera gear, or family jewelry is fully covered under the larger number can be shocked to learn only a few $1,000s of that applies to those specific items. The fifth pattern shows up mostly in health insurance, inside the phrase reasonable and customary charges. Insurance companies will only pay what they consider a reasonable and customary amount for a given treatment, based on their own internal data, not necessarily what your actual doctor or hospital charges. If your provider charges more than what the insurer considers reasonable, you can be billed for the difference yourself, a practice often called balance billing. This is precisely why confirming a provider is fully in-network and not just accepting insurance in general matters far more than most people realize before treatment begins. There is one more distinction worth understanding clearly, and that is the difference between a deductible and an out-of-pocket maximum. Two numbers people often confuse until it costs them money. A deductible is the amount you pay before insurance starts contributing at all. An out-of-pocket maximum is the absolute ceiling on what you will pay in a given year, after which the insurer covers everything else in full. A policy with a low deductible but no clear out-of-pocket maximum can end up costing far more during a serious illness or a major claim than a policy with a slightly higher deductible but a firm, protective ceiling. When comparing two policies, the out-of-pocket maximum often matters more for your real financial protection than the monthly premium ever will. This pattern becomes even more visible after major disasters. Following large hurricanes and wildfires, it is extremely common to see news coverage of entire neighborhoods where homeowners believed they were fully covered, only to discover afterward that specific causes of damage, like flooding from storm surge as opposed to wind, fall under completely different coverage, sometimes requiring an entirely separate policy purchased months in advance. It is rarely one dramatic scam. It is usually dozens of small, technical distinctions buried across pages of legal language, each one shifting a little more of the financial risk back onto the policyholder. None of this means insurance itself is a scam or something to avoid. Insurance genuinely protects people from situations that could otherwise be financially devastating. The real issue is that most people sign these contracts the same way they scroll past a terms and conditions page, trusting that the summary they were told matches the actual legal document. It rarely matches perfectly, and the gap between the two is exactly where claims get denied or reduced. So here is what actually helps. Always request the full policy document, not just the summary, before you buy, and specifically read the exclusions and limitations sections first. Ask directly whether you have actual cash value or replacement cost coverage, and consider paying extra for replacement cost if the option exists. Keep dated photos or video of valuable belongings and your property stored somewhere outside your home so you have proof if you ever need to prove a loss. And before disaster ever strikes, call your provider once, calmly, and ask them to walk you through exactly how their claims process works, what documents they require, and what their expected timeline looks like, so you are not learning all of this for the first time during the worst week of your life. And if a claim ever does get denied or reduced in a way that feels unfair, remember, that decision is not automatically final. Insurance companies expect most people to simply accept the first answer they are given. Requesting a written explanation of the exact denial reason, referencing the specific policy clause involved, and formally appealing through the insurer's internal review process changes outcomes more often than most people expect. If that internal appeal still feels unjust, every state has an insurance regulator whose entire job is handling exactly these disputes, and filing a complaint. Their costs nothing but a little time. The fine print exists because most people never read it. Now that you know exactly what to look for, you are no longer most people. If this changed how you will read your next policy, subscribe, because next on this channel, we are breaking down the exact math behind renting versus buying a home, and the numbers might surprise you.